Holy smokes everyone, recession risks are piling up and investors need to get ready. And in today's video, I'm going to go over all the indicators that prove we are going to enter a painful recession and why this may possibly rival the Great Depression. Never has this topic been so important than today, because I've been talking to family and friends and I know personally they are all feeling the pain right now from higher food costs, higher gas prices, and higher heating and utility bills. So everyone, we got a lot to cover, so let's not waste any time. Let's get straight into it. Even after one of the worst starts to an equity trading year in history, the market upheaval might just be getting started. Ominous signs are piling up that more turmoil is still coming, as key indicators point toward a potential recession that could deepen the market rout triggered by the Federal Reserve leading a hawkish shift among central banks and war in Ukraine. The US Treasury yield curve has collapsed to a near inversion, a situation where short-term rates exceed those with longer tenors, which has often preceded a downturn in Europe. Energy costs have climbed to an unprecedented levels as sanctions against Russia exacerbate a global commodity crunch. And look at this everyone, recession risks are piling up and investors need to get ready. So what is the first indicator and what is a great indicator we can use that have predicted every single recession since 1970? Well everyone, what that is a 2 and 10 year US Treasury yield curve. That is the difference between the interest rate of the 2-year Treasury or the 2-year bond rate and the 10-year US Treasury interest rate. Now what happens when the interest rate on the 2-year Treasury yield goes above the interest rate on the 10-year Treasury yield, then that indicates a recession is likely and that it's going to be some economic pain coming ahead. Because look at this chart everyone that proves this, the 2-year versus the 10-year US Treasury yield curve. We can see in the 80s recession, the 90s recession, 2000, 2008 and 2020. And another chart we can see here everyone, the yield curve has been falling from around 1.6% at the start of 2021 in April, and now it has collapsed to 0.25%. So it hasn't quite inverted yet, but it is getting closer and closer by the day. But this is just one of the many indicators that are flashing code red right now. Over time, the 3 biggest factors that tend to drive the US economy into recession are what we just went over, an inverted yield curve, some kind of commodity shock, or Fed tightening. Well, what is happening right now, everyone? We have the yield curve flattening, we have absolutely skyrocketing commodity prices, which we'll get into more in a moment, and we have the Federal Reserve going into a rate hike cycle and a tightening cycle. So this is the perfect storm that is happening right now, but let's dig a bit deeper to see how bad the situation is that we are really in. Well, something that's definitely going to hurt consumers right now, everyone, food prices are already past levels that contributed to an uprising in the past, and the outbreak of a war between Russia and Ukraine, which combined account for 28% of global wheat exports and 16% of corn. According to UBS Global Wealth Management, this only adds to the risks. And so what is this causing? Look at this. US consumer sentiment hits an 11-year low. And of course, what's behind it? Skyrocketing inflation. The University of Michigan's preliminary consumer sentiment index dropped to 59.7 in the first half of this month, the lowest reading since September 2011. So US consumers are even more worried right now than they were during 2020. From a final reading of 62.8 in February, economists polled by Reuters had forecast the index falling to 61.4. And the trend I'm starting to see, everyone, is these forecasts are getting slashed lower and lower by the week. But with consumer debt at record highs, with people piling into credit card debt, consumers are about to be dealt another blow. Meanwhile, the Fed is unlikely to intervene to prevent sell-offs, according to Deutsche Bank's global head of currency research. That's because the root cause of the current spike in inflation is a supply shock, rendering the playbook used to fight downturns for the past 30 years all but useless. That is exactly right, and that is spot on everyone. What has the Federal Reserve had the luxury to do over the past 30 years to bail out the markets again and again? Well, they've been able to lower interest rates lower and lower, they've been able to print more and more money, and there's been no cold high inflation. When we all knew in real terms there has been inflation, but the official CPI, there hasn't been that much high inflation for the past 30 years. But now inflation has gotten so out of control, even the Federal Reserve can't hide it anymore. And we all know that the real inflation rate, when you look at shadow stats, the way they record inflation at the 80s, it is showing that inflation is really at 16%, the highest it's ever been since World War II. So really this is a lose-lose situation for the Federal Reserve, and this is the price we're about to pay for the Federal Reserve and the US government kicking the can down the road for the past 30 years. Eventually you have to face the music, people. Either they lift interest rates to bring inflation under control and brings us into a painful recession or even depression, or they don't and they let inflation inflation run out of control, and that is going to make the price of food skyrocket, the price of gas skyrocket, and the price of utilities skyrocket, and people aren't going to be able to afford the basic essentials. They're going to become luxuries. So really the Federal Reserve is cornered and there's no way out. And look what this is leading to investment banks like Goldman Sachs to predict. Goldman Sachs warns Russia's war on Ukraine could plunge US and Europe into recession. Goldman is also blaming the Russian invasion of Ukraine for its souring outlook on the world's biggest economy, the US. It lowered its full year 2022 GDP growth forecast for the United States by 25 basis points at 0.25% to just 1.75%. Am I the only one seeing this, people? They're saying that the economy is only going to grow by 1.75%. So if we don't technically enter recession, if inflation is 8% and GDP is only 1.75%, well, in real terms, that means the US economy is in a recession. And what I think is happening right now is, in real terms, for the average American, or really the average citizen in the West and in Europe right now, it feels like we're already in a recession with skyrocketing food costs, fuel costs, and commodity prices. I know personally many friends and people that are struggling right now, and for them it is feeling like a recession already. So even if all the talking heads on CNBC or the data says we're not in a recession, just look to see what the average person is feeling and how they're spending. And remember, the stock market and the markets are not the economy. So what we're seeing right now is the wealth gap widen even bigger and bigger. And yes, times are good for the 1%, but definitely not for the 99%. But also what people in the US have to pay attention to right now is what's happening in Europe, because people were starting to see the European markets enter a bear market, and we could see another European banking crisis just like in 2008 and 2009. Look at this, Europe exodus. While the year started with bullish bets on European stocks, that's ancient history now. Record inflation, a surprisingly hawkish pivot by the European Central Bank, and Vladimir Putin's attack on Ukraine have changed everything. And a max exodus from the region stocks is in full swing. And really, Europe has been in stagflation for the past 10 years. They've had very, very low growth, and they've already dropped interest rates in some countries into the negative, so they don't have any tools to fight off this recession anymore. And like we're seeing how interconnected the global economy is, if we do see a financial crisis or a painful recession in Europe, we're also going to feel this in the West as well. And if you're wondering how we can use this information to predict what may happen in the markets or what may happen to the stock market, here's some insights here. The US market anticipates the start of a recession by an average of 7 months and bottoms by average of 5 months before the end of recession, according to CFR data going back to World War II. And with the Nasdaq nearly in a bear market right now, with the S&P and the Dow in correction territory, I think the markets are starting to price in the possibility of a recession right now. But if we do enter a painful recession and it gets worse, well, I expect this sell-off in the markets will get much worse as well. Because people have just been saying, look, Michael, you're just spreading doom and gloom. There's no crash. Where is the crash? Show me the data. Show me the money. Well, you want to know the truth? You can't handle the truth. Look at this, everyone. 10 trillion and counting. World stocks have lost more than 10 trillion in market value this year. So people, like I keep saying again and again, the markets aren't going to plummet 50% overnight. It's not going to be a drop of 1-2% consistently every day. We're going to have a lot of volatility. It's going to be a very bumpy ride, so you can't FOMO into these dead cat bounces and these bull traps. So okay, the yield curve is inverting, commodity prices are skyrocketing, consumer sentiment is down, the Federal Reserve is going to rug pull the markets and lift interest rates, and there's nothing we can do about it. But what can we do to protect ourselves and protect our portfolios? Well, listen up, people. You need to start paying attention right now before it's too late. Look at this, everyone. What has been performing and what hasn't? We can see here the worst performer, Bitcoin. So even though I do like Bitcoin as a speculative asset and as a hedge against inflation, maybe over the long term, not in the short term, and as an alternative to the banking system, it has been the worst performer, down 14%. Stocks are down 10% year to date. Investment grade bonds down 7.2%. High yield bonds down 6.9%. Government bonds down 4.1%. But what have I been telling people to protect yourself during this downturn? Look at this. Now, these returns aren't spectacular, but at least you're not losing 10 and 15% like in stocks and Bitcoin. look, US dollars, they've been holding their value because the dollar has been rallying. So it's always good to have a bit of cash on the sideline so you can buy these dips here in Bitcoin. Stocks, that is up 2.4%. Gold is up 4.8%. So all you bullion investors, you've been doing a lot better than Bitcoin investors and stocks. And remember, there's a time and season for everything. So I'm not married to one asset class, but it's all about the cycles. But look at this, commodities, 38%. And look at this, everyone. In April 2021, I told you, look, if you want to protect yourself against inflation and fiat currency debasement, you need to start investing in commodities. And I said in this video that they will strongly outperform our stocks, but unfortunately not many people watch this video with only 21,000 views. So I do try to help, but then eventually no one really watches it when I try to be helpful. But for those my viewers that did invest in these commodities in April 2021, you're definitely doing much better than an average stock investor. And something I said that I was investing in that I thought would do much better than the S&P 500 is the S&P GSCI index. This is an index of all different kinds of commodities, and that is up 60% over the past year. But commodity prices have already had a huge run up, so I'm still not sure if there is more room to go in these commodity markets. But if the supply chain issues get worse, if we see the conflict going on around the world get worse, I do think commodities and energy stocks and miners will benefit from this situation. Now, not only this, but also some unconventional investments I've been doing is things like buying my fuel and storing it 3 months in advance to get ahead of this inflation. I've been adding to my food storage for the past 3 months to protect myself against rising food costs. And this is just really a guaranteed risk-free return. And that way, if you get a pay cut during the next recession or lose your job, at least you have a cushion to fall back on. And also you want at least a 6-month emergency fund and some cash on hand in case the online payment systems go down. So everyone, again, the macroeconomic picture is not looking good. The market fundamentals are not looking good. I think there's going to be pain coming ahead. And this is just some short, quick ways you can prepare for the coming crisis. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you're interested and want to get up to 5 free stocks with Moomoo and a guaranteed free stock in Neo, I'll put a link in the description. Thanks for watching. I'll see you in the next video.